Yo, what's up, guys? Welcome to my YouTube channel. This is NeoFX. Um, this channel is well dedicated to improve your trading skills and to like expatiate your knowledge about trading. Any type of courses you want, you can find it in this YouTube channel. So, for more videos, just click on the like button, subscribe to my YouTube channel, and on the notification button for you to get my latest videos and all these useful videos that will help you in the long run. So now for today we'll be talking about making use of technical analysis to get in and out of your trade, to know when to get in and to know when the trade the market is not suitable for you to get in. So if we are going to be talking about technical analysis in market, there are three things you need to take very note of. So this video is very well comprises of these three things I'm about to mention. The first one is knowing the trend of the market. If you are going to start with your technical analysis, you need to first know the trend of the market. Knowing the trend of the market is what you need first. And then the second thing that you'll be learning in this video is mapping out your point of interest. And then the third thing you are going to learn in this video is proper usage of risk management, your risk to reward as well. So these three things is what I'll be breaking down for you guys to be able to understand and for you to be able to learn one or two things from. So now, starting with knowing the trend of the market. Knowing the trend of the market is by just trying to get the direction of the market. The market always tells you its direction. The market always tells you its path. The market always tells you where it's going, how it's moving, and when to get in and just tag along. You understand? So for you to be able to identify the trend of the market, you need to understand that there are three types of market trend. Note it down. There are three types of market trend. We have the uptrend, which is also called bullish trend. We also have the bearish market, which is also called a downtrend, and we also have the sideways trend, which is also ranging market. These three types of market trend are what you need to know to get the direction of the market. So now I will start with the first trend, with the first trend of the market, which is uptrend, which you can also call bullish market, bullish trend rather. So when we are talking about bullish trend is when the market is moving upward. It is when you notice the market is just pushing up, pushing up, pushing up, and pushing up. That is what you need to understand by bullish trend. When you talk about bullish is when the market is moving up. That's just the simple definition of what we call bullish trend in the market. So when you are talking about the bearish trend is when the market is moving downward. The bearish trend is when the market is moving downward, when you see the market dumping, aggressively dumping, and keeps dumping. That is when you realize that the market is in a bearish trend. And then the third one, which is the last but not the least, the last one is called ranging market, and you can also call it sideways movement of the trend. Like it's when you see the market just moving sideways, just keeps on moving like this, like this, like this, and like this, like this. That's what you call a ranging trend. Are you getting me? So now with this simple three trends I just made mention and I just defined for you, I would like to show you how they always look like in the market. I will make the drawings, and after I'm done with the whole thing, and then we'll now dive into the charts to make you see these things in real time, to make you see these things how they appear in the market chart. So now let's start with the first one. The first one is what we call bullish trend. Bullish trend. If you see the market moving like this, market moving like this, market moving like this, and like this, and like this, this is called a bullish trend when you see the market moving upward. This is called a bullish trend. You will always see the markets moving like this. When the market is moving up, you will always see the markets moving like this, up, down, up, down. So that is what you know about bullish trend. So I'm just going to like state this for you. This is a bullish trend. Let me just quickly help you. Just put it here. Bullish trend, also called an up trend. So this is a typical example of what I mean by bullish trend and an uptrend. So that is when you know when to get in. That's when you try to get the direction of the market. So after I'm done with this, I will now let's now go to the second type of the trend of the market that we have, which is the bearish trend. The bearish trend, like I said, is when the market is moving down, when the market is keeps dropping. So then let me now show you how the market always looks like when it drops. When you see the market moving like this, when you see the market moving like this, when you see the market moving like this, you see the market moving like this. This is a bearish trend. When you see the market moving downward like this, it's called bearish market. It's called bearish trend. This is called a bearish trend, in which you can also call it downtrend. Downtrend. So this is exactly how it looks like when the market is moving downward. So you call the one moving up bullish trend, which you can also call it uptrend. It depends on how simple you want things to be with you. Don't always allow all this English to just mess up your head. You understand? A lot of people comes with different kind of names in the market, but just always try to simplify everything you're learning. So that's also trying to like make things easier for you to understand. So now these are the two types of the market trend that we've talked about so far. So let me quickly show you how the sideways movement is always like. So the sideways movement is always like this. And you see the market creating equal highs. Equal highs. So this is a ranging market. This is a ranging market. This is a ranging market. What ranging actually means is just that the market is just moving in a range. The market keeps moving in a range, no specific direction. That is what the ranging market means. So now that you can now easily identify each type of market trend we have, I need to make you understand the differences in this market trend. What to do and what not to do in this market trend. The situation of the market tells you what to do. You understand? It tells you what you need to do. What you need to do in the market depends on what's currently happening with the trend. So that is why it is always very, very, very much important for you to first identify the trend of the market. You don't just come into the market and be like, oh, because the market is moving up, you want to enter a buy, or because the market is moving down, you want to enter a sell, or because you feel like, oh, the market has went up too much, it's now time for you to start selling, and you enter sell, and then bam, you blow your account. No, you come into the market with a specific plan and direction. So now, I will now tell you the differences between these type of trends that we have in the market. With the bullish trend, is always like creating series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And these things that I just made mention of is like a composition that forms what we call an uptrend. An uptrend is composed of what we call higher highs and higher lows, higher highs, higher lows. So I will talk more about these things in another course, which is called like market structure. I will make another video talking about market structure. So in that video, you will always you will be able to understand what I rudely mean by higher highs and higher lows. Market structures helps you to understand the turning point of the market. You understand? But for now, just stick to this one. I will drop the video later, and then just make sure you click on the notification bell so that you'll be able to be updated. You will keep yourself updated with whatever videos that will help you, that is going to help your journey. Are you understanding me? So now let's dive into the differences that we're talking about. So now the difference is between bullish trend, bearish trend, ranging market. The bullish trend is just like the opposite of bearish trend. It's just as simple as that. It's like the opposite of what we call an uptrend when you're talking about bearish trend. And then the ranging is when the market has no specific direction. When the market is not telling you, okay, I'm either going up and down. So now I will now make you understand. I will now bring you to understanding where we're going with the course for today. So now look at this clearly now. What an uptrend is composed of is series of higher highs, higher lows. Now look at this diagram very well. I do this so that for you to understand what's currently going on. Now look at this diagram right here. As you can see, you can see HH means higher highs, and when you see HL, it means higher lows. So now, for you to know when to get in and when to get out of the trade, you need to first understand that when the market gives you a higher high, the market must make sure the market gives you a higher low for you to join in. You don't just join the market wherever you see that you feel like. You understand? You must always wait for the market to just come to you first. So that's why you need to understand the anatomy of how everything moves. You need to be able to blend yourself with the nature of how the market moves. So when you understand the market structure, so by that time you'll be able to understand the fluctuations in the market is just the nature of the market. That it's just the natural movement of the market. Whenever you see a lot of fluctuations in the market, it's just the natural behavior of the market. So that's why you don't need to panic. You don't need to be worried that you might get in the trade too late. You don't want to miss out on whatever thing that's going on in the market. You need to always chill, plan, know exact thing that you're doing in the market. That is very, 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 very important. So now you need to make sure that when you are looking at an uptrend, you need to first make sure, is the market giving me higher high, and is the market creating higher low? So when you are when you can easily identify, the market has given me a higher high, definitely the market will give me a higher low. So that higher low is where I will try to get my this thing. The same thing goes well with the bearish trend of the market. The same thing goes with bearish market. The market will always give you a bearish market. So when the market gives you a bearish market, you need to understand as well that it has to give you different kind of things, just like the uptrend that I just made mention of. When it comes to bearish market, you will always see the market giving you a lower high, lower low, lower low, lower high, lower low, lower high. As you can see, I made mention lower low. This is the lower low. This is the lower high, lower low, lower high. So whenever I'm seeing the market giving me a new lower low, I'm expecting the market to give me a lower high for me to find my entry. Are you getting me? So if you are caught up and the market has already broken the structure, wait for the market to finish its lower low before, and wait for the market to give you a lower high for you to jump in. It's very as simple as that. And for a sideways trend or a ranging market, it is always very not well advisable for a newbie to try to try to trade this ranging market. You always need to like wait for a breakout. You need to wait for a breakout because the market will always give you a equal low or equal high. The ranging market will always give you a equal high, a equal low, equal high, equal low, equal high, equal low. So instead of you seeing higher highs, higher lows, higher highs, higher lows, when you are seeing a ranging market, the market will always give you what I call, not just what I call, what many traders call equal low. Equal low. This is equal high. This is equal high. This is equal high. And here you find your equal low here. So all these touch points under this resistance, all these touch points to the resistance is what you call equal low. Equal low. So this is equal low. So whenever you are seeing the market ranging, you always experience the market giving you a equal low. So that is what you necessarily need to identify where the market is going. So let me just give you a recap of what I said about market trend. The market either goes up or down, or the market as well goes sideways. So now that is the three types of market trend we have, and you need to pay attention to how they always move. Draw out all these type of these drawings that I just do for you guys, for you to be able to know what is going on. So now I'm not going to go to the second aspect of this video for today. Now I'll be talking about your point of interest when you need to get in a trade in a particular trend. For an uptrend, you always have to make sure that you are always trying to like get in at an higher low. Now let me give you this drawing. Look at this drawing right here. As you can see, I mapped out this zone from a higher high. So the market will always pull back to your support level to bounce back up. So when the market comes to support level, you always see the market trying to like be sluggish in that zone, and then you just see boom moving up. You just see the market boom moving up. So by that time the market has already given you a higher low. So me mapping out this level right here is my own point of interest in a bullish trend. This is where I'm interested in thinking about. So when the market gives me a higher high, higher low, and then the market gives me another higher high, I will always wait for the market to give me a higher low, so as for me to get in on a trade, and then boom, I enter the market. You understand? So now the thing is, you need to always be specific about where you are getting in on a trade. You need to be always aware of where you need to get in on the trade. So now let me now go to your point of interest whenever you see a bearish market also. So whenever you're seeing a bearish market, you are always waiting for the market to come to your resistance level. Your resistance level is always located at the last lower low on your chart. As you can see, lower low, lower high. The market created a lower low. The last lower low before this one is where you are expecting the market to tap for it to now create a new lower low with the market. So this is exactly your point of interest. It's like you always let me just give you a simple thing for you to understand. Whether in an uptrend or a downtrend, always wait for a breakout. After waiting for a breakout, wait for a pullback to that support or resistance level, and then execute your trade. And then for that will give you a very good risk to reward for you to get in and out of the trade. Are you understanding me? So now that brings us to the last type of point of interest in the last type of market trend that we talked about. So for me personally, I don't love to trade the ranging market in a lower time frame. It doesn't give me a good profit, even if I decide, okay, let me hold the trade for long. But for A ranging market in a higher time frame, like a 4 hour time frame or a daily time frame, if I notice the market is giving me a ranging market, what I usually used to love to do is just wait for the market to tap to my support level, to tap to my equal high, then I execute my sell. And when the market taps into my equal low, I execute my buy. So that's what I will keep on doing until there is a break of structure, whether towards the upside or towards the downside. So, and then again, if the market breaks out of that range, that's another time for you to make another money. So whenever the market officially breaks out of a range, then you have to always wait for a pullback to the support to the support level or the resistance level. That is your point of interest. So whenever I see the market break out of a range towards the downside, I wait for a pullback to this resistance, then I sell the market. Or if I notice the market breaks up after the market is giving me a higher high, I wait for the market to give me a higher low, then I execute my trade right here, then I take profits above here. It's just very simple as that. Are you understanding me? So now let's now dive into the last part of the course for today. So now I'll be talking about the risk management, the usage of your risk to reward. Whenever you are taking the trade, always have in mind, oh, with this thing, I'm willing to risk this amount of money to gain this amount of money. So the amount of money you are willing to risk tells you your risk to reward. You understand? So now let me now tell you, there's one thing about risk management. Always stick to risk management. Risk management is what places you in a safe and reliable position. Instead of you risking all your account balance at once, the market will be like your risk management will be able to allow you to risk 10%, 5%, 2%, even 1%. Your risk management will be able to will allow you to risk small and gain more. To risk small and gain more. So whenever you hear traders talking about risk to reward like 1:2, 1:3, 1:1, they are literally saying, for example, I'm planning on risking $100 per trade. So whenever I'm risking $100 per trade, it means I'm willing to like get $200 in return, $300 in return, $400 in return. That is if it is 1 is to risk, if it is 1:4 risk to reward. And if it is 1:1, it means that you are risking $100 to get $100. So it is very crucial. After you understanding these simple things that I just explained today, you need to always understand that your risk management is as very well much more important as you identifying the trend of the market. Even most of the times, risk management is what matters the most. You understand? So you don't want to get yourself caught up in a lot of bullshit in the market. If you are not careful, when the market takes away from you, it takes away from you big. The market always tries to take away from you big, but your risk management will place you in a safe mode. Your risk management will place you in a safe mode. So that is why your risk management is always very well important. There is no, I can say it 1,000 times, there is no single trader in this world that is profitable. A single trader that tells you that is profitable, go and check him. He makes use of his risk to reward. He makes use of his risk management. Go and check Abby Forex, go and check Jeffrey Benson, go and check Willis, go and check Dapper Willis, go and check Alex G, go and check Lucky Main, go and check go and check VIX 75 traders. Go and check any type of traders that you find out there. Go and check them. They will always make you understand that risk management is very well important. So if you understand these basic 3 things, I can assure you that you make money in the market. You know the trend of the market, you plot out your point of interest and you place your trades, and most of all, you make use of a risk management. Those 3 things is enough for you to make simple money in the market. So this video is going to be very helpful for you. Whenever you're watching this, it's going to be very helpful for you so that you won't get caught up in those people that are liquidated in the market. And then mind you, it is very well important to make money in the market. Always make sure you make money in the market. If the market takes from you, make sure you take back from the market. That is what puts you on the safer side. And so, let me just give you a very simple thing that you need to know when you're talking about risk management. There is nothing like risk management when you do understand the right usage of lot size. Your lot sizing must be accurate. Your lot sizing must blend in with your account balance. Your lot sizing must blend in with the amount of money you are willing to risk per trade. If you want to risk $100 per trade on gold, you should not be using one starter lot size. You can't say you want to risk $100 per trade and be using one lot size on XAUSD. It does not blend in with the amount of money you say you want to risk per trade. So whenever you're talking about risk management, you are talking about lot sizing as well. You see, lot sizing, risk management, market structure are the videos I'll be making more. So that is why it is very much important for you to just click the like button, subscribe to my YouTube channel, and then on your notification button so that you can get more videos that's going to be very well important and very well helpful for you. So that's that for today. Check out my other videos that you watch online. Watch out for my videos. My videos is always a bomb that is going to help your life. There are some type of bombs that helps your life too. Anyways, that's that for today. I hope you guys enjoy your day. Alright. And make sure you're profitable. That's very important. Bye guys.